the class saying that we've got 5 adjusting entries that I'm going to be really worried that you have. All right? We talked about the first one. Remember what it was called? First option is something called prepaid expenses. Okay? And there's a few things that we have to make really second nature when we talk about adjusting entries. And one of those things that has to become second nature is what we debit and what we credit when we actually go to make the adjusting entry. Alright? Anytime we can identify a prepaid expense, alright, if we recognize a prepaid expense adjustment, I'm always going to debit some expense account, and I'm always going to credit some asset account. That's what it always looks like. Okay, we'll debit some expense and we'll credit some asset. Now, on the exam, when I ask you to do adjusting entries, you can't just write expense and asset. Okay? You got to be specific about which expense and which asset. That's just the generic form right there. Okay? So we'll go through a problem. I don't know if we will get to it today, but we'll go through a problem and you'll see actual expense and actual assets being adjusted a little bit later. The other side of this is, and here's the question. Okay, I'm not just writing words up here to, there's a question behind it. Okay, there's a reasoning. If I do not do this adjusting process, all right, if I don't do it, how does that impact my financial statements? Because remember where we're going here. All right, we're going to post these entries to a ledger just like we did the last entries. That's going to flow through to an adjusted trial balance in this case. And from the adjusted trial balance, we put together our income statement, statement of owner's equity, and balance sheet. All right, so the numbers that are on that adjusted trial balance eventually show up on our financial statements. Okay, so when you look at financial statements, if you go to Yahoo or something like that and look at a company's financial statements, you're looking at numbers that come from the adjusted trial balance. Okay, well those numbers come from what? Adjusting entries, which come from what? The unadjusted trial balance, which come from the ledger, which come from the journal entries that go on in day to day. Okay? So understanding that cycle and how things flow through is vitally important. So if I don't do this, all right, it comes back to basics. When I debit an expense, what am I doing to the expense? Increasing or decreasing it? Increasing. I'm increasing the expense. All right? So if I don't do this, if I don't increase this expense, this flows through. This is going to hit the ledger. This journal entry will hit the ledger. It'll hit my adjusted trial balance. And from there, it'll find its way, this expense, onto the balance sheet or income statement. Well, expenses go on the income statement. All right? So this is going to flow through the accounting cycle all the way to the income statement. That's the final place it'll end up. Okay? So if I don't do that, my expenses will be what? Expenses will be understated. All right? If expenses are understated, let's think this. There's logical progression here. If expenses are understated, in other words, I didn't recognize enough expense, then income has to be what? Income has to be overstated. All right? The other impact is going to be on the balance sheet. All right? So this half of the entry flows through to the income statement because expenses find their way to the income statement. Assets, this half of the entry flows through to what? Balance sheet, because assets show up on the balance sheet. Okay? So this is going to flow through. It's going to hit the ledger. It's going to hit the adjusted trial balance. And from the adjusted trial balance, we're going to create a balance sheet. So if I credit an asset, what am I doing to that asset? Increasing or decreasing it? I'm decreasing the asset. So if I don't do that, then what? Assets will be overstated. Okay? So, you need to know what the 5 adjustments are. We've only talked about one of them so far, prepaid expenses. Okay? You need to know the general form of the entry, debit expense, credit asset. You need to know the effect if we don't do the entry. All right? If we omit the entry, if we don't do our adjustments, what happens on the financial statements? Okay? Got it? Yes, okay, all right. I think so. All right. Second one is on page number, I gotta find it here. It's talked about on page 107 and also on page 113. Okay, 107 and 113. Here it is. This is a tricky one. Unearned revenue. We talked about this one a little bit. I'm going to introduce you to a new account. And this is anytime I introduce a new account to you, I try to do that anytime you get an account that you haven't heard of yet. I'm going to tell you 3 things about it. I'm going to expect you to know 3 things about it. Okay? Unearned revenue, first, is a liability account. Okay? And because you know it's a liability, its normal balance is A. In other words, what makes it go up? Credit. Okay? And because it's a liability, it shows up on the balance sheet. Okay? So, unearned revenue, here's what we're dealing with. Someone hands you a check. Okay, I think we talked about this a little bit. We talked about rent. Maybe if you hand me a rent check for $6,000, I have what? I have the money. I haven't what? I haven't given you the house. Okay, I owe you the house for 6 months. Okay? So unearned revenue is literally that. It's money that I have that I haven't done what? I haven't performed the service. Okay? It's you hand me $100 and say, hey, come mow my yard next week. Okay? Well, I've got the money. I can go spend it on whatever I want to. But I still owe you what? I got to go mow your grass. Okay? If I don't come mow your lawn, I got to give you the money back. Right? Okay. So that's unearned revenue.
That wouldn't fall into if you did the service and somebody owed you money?
That's a different one. That's an accrued revenue. That's our next.
Okay.
That's our next. This is the exact opposite. I have the money. I owe the service.
Okay.
Okay. The opposite of that is I performed the service. I haven't gotten the money yet. So yeah, good question. All right. So unearned revenue. All right. What does the entry for unearned revenue look like? The entry is on page 113, and it's in that little green box that you see right there. Here's what it looks like. You will notice that the entry, if you're following along, is a debit to unearned rent. Okay? So we're going to debit, and rent, they just replace, they're calling it rent revenue. It's a specific kind of revenue. We'll go with unearned revenue or unearned rent. We're going to debit a liability. All right, so let's try to process this. Because that looks funny. Out of all the entries we ever do, the one that students are the most uncomfortable with, for some reason, is debiting liabilities. It just feels completely weird to you. What do I know about a liability? When I see the word liability, it's what? I owe. Okay? In this case, I don't owe money. I owe a service. Okay? I still owe. All right? It doesn't matter if it's money or service or what. Yeah, I still owe. And I still have to recognize that on my books. All right? So, typical liability accounts, of which our unearned revenue or unearned rent is one, are increased on the credit side and decreased on the debit side. So you can see that, okay, again, it comes back to basics. If I do this, if I debit a liability, I'm doing what to the liability? I'm decreasing the liability with that, okay? Which means what? This is one of those that just because time passes, you know, that's one of the reasons we have to do adjustments. Just because time passes, I have to do this entry. Okay? Why? Okay? Why am I decreasing the liability? Because I paid what I owed. Okay? So I'm decreasing the amount that I owe. Alright? So I have a debit to a liability. I have a credit to revenue. Okay? I have a credit to revenue. Credit to revenue. Alright, typical revenue account. Debit side or credit side increases revenue. Credit increases revenue. Okay, so here I am. I'm reducing my liability. I am increasing revenue. Okay, so again, we have to know our rules of debit and credit. You know, what side makes what do what. So, that's the general broad form of the entry. Again, don't on the exam, when I give you an adjusting entry, right, debit liability, credit, we will have actual real accounts that we'll look at. But that, again, is the general form. Now, let's think about this. If I don't do this, let's start with the income statement, the revenue side, okay? If I don't do this, all right, here I am crediting revenue, which means I'm increasing revenue. So this half of the entry is going to flow through and eventually land where revenue counts will land, and that is on the income statement. So if I don't credit revenue right here, revenue is going to be what? Understated. Revenue will be understated. Now, if I understate revenue, income will be what? In other words, I didn't recognize enough revenue. All right? Income will be what? Understated. Income, understated. Now, let's think for a second. What would motivate anybody to understate income?
If they were taking money out.
Do what?
Themselves, if they were taking money out themselves.
Okay, there could be some sort of criminal intent, all right, to where we don't want to make this revenue look as high because somebody's taking money out of the firm. What else? Less taxes, right? That's probably your more common, all right? If I have lower income, then what? I pay fewer taxes on the income, okay? So, there's motivations for people not making these adjusting entries, okay? It's incorrect, but there are, okay? So, if I don't do this half of the entry, what's the impact? Revenue is going to be understated. If revenue is understated, by definition, mathematically, net income is going to be understated. Now, the other half. Liability. If I don't do this, liability will be what? Remember, I'm debiting a liability, which means I am decreasing. So if I don't do this, liability is overstated. Alright, so, again, we need to know the general forms, we need to know the results. This is that's the important stuff, okay? Alright, third one. Accrued revenue. Accrued revenue. Accrued is a word that freaks people out, okay? Don't be freaked out by it. Okay? It's just an accounting word that sort of stands for it builds, okay? Or it builds and I haven't realized the money yet. I haven't received the money yet, okay? So here's an accrued, this is straight from the book. Here's what it says. During an accounting period, some revenues are recorded only when cash is received. Thus, at the end of an accounting period, there may be revenue that has been earned, but what? Has not been recorded. All right? Back at the beginning of the chapter, the third reason why some of these adjusting entries are made, some revenue expenses may be unrecorded. In other words, what? We just didn't pick it up when we should have. Okay? So the adjustment process I told you sort of acts as a catch-all as well for any mistakes that we made. Okay? So we're looking back through the records. Here we are at the end of the accounting period. We're looking back through the records and we're thinking, oh my gosh, I forgot, we billed this person. They came into the doctor's office. We checked them out, made sure they were okay. We billed them. I forgot to record it. Okay? So the adjusting process affords you the opportunity of what? Making those entries. Okay? So accrued revenue, again, here's what it is. Revenue that has been earned, but has what? Not been recorded. That's it. Okay? So pretty simple definition. Here's what the entry looks like. I'm going to debit some asset account. Typically, at this stage in the game, that asset is going to be accounts receivable. Accounts receivable means what? Somebody owes me money. Okay? I have performed the service. Oh, and this is what you were talking about. I have performed the service. I have not what? I have not received my money. Okay? So, usually accounts receivable is going to be your debit. Your credit, it's a dead giveaway. It's right there. we're going to credit a revenue account. Okay, debit the asset, we'll credit the revenue account. Alright, now, if I don't do this, remember this flows through. It's the ledger, it's the adjusted trial balance. From the adjusted trial balance, I create my financial statements. So this half of the entry, the asset side, alright, will flow through. It'll find its way to the balance sheet because that's where our assets go. Alright, what am I doing to the asset here? So let's start assets. Alright, if I don't do this, remember that's the question. If I leave that entry out, then what? I'm debiting an asset. A debit to an asset does what? Increases the asset. So if I don't do this, assets will be understated. The other half of the entry, if I don't credit revenue, then what? Revenue is going to be understated. Mathematically, if revenue is understated, then net income will be what? I heard both. If I understate revenue, in other words, if I don't have enough on the revenue side, what's that going to do to income? It's going to understate. Understated. Okay? Here's the way you think through that. If I put an income statement up here, just a really, really crude one. Revenue is 100. The expenses are 50. Net income is 50, right? According to the math. If I understate revenue, we'll keep expenses the same, but I understate revenue by 10. What impact will that have on income? If I'm going to say it's 40 and it should be 50, so we're understated. Okay? Alright. So, now we know about three. Prepaid expenses, accrued revenue, and unearned revenue. So, prepaid, unearned revenue, and accrued revenue. The fourth type is accrued expense. Accrued expense. And accrued expenses are covered on page 115 if you need something to come back to. Here's the general form. I will debit an expense. I will credit a liability. Okay? I'll debit some expense and I'll credit some liability. The definition of accrued expense is on page 115. Here's what it says. Some types of services used in earning revenues are paid for after the service has been performed. We talked about this a little bit. We talked about the electrical bill. Okay? We're receiving the electricity right now. Okay? When will we get the bill? We won't get the bill until sometime in October. So we won't actually pay it in October. But we have to do what? We got to match expenses with revenue, okay? You got to understand, to the university, your revenue, all right? So we got to do what? If I'm sitting here teaching you, that's revenue. I got to do what? I got to match the expense with the revenue. So I can't wait until I pay the bill. I got to recognize it this month, okay? Which means I have to what? Estimate, right? Okay, but we do have to estimate, all right? So there's the entry. General form, debit expense, will credit some liability. Now, if I don't do this, let's start with the expenses. If I don't debit the expense, debiting expense increases the expense. So if I don't debit the expense, my expenses will be understated. I'm not going to recognize enough. Alright? If expenses are understated, net income is what?
Overstated.
Overstated. Good. The other action here is on the liability side. When I credit liability, I'm doing what? Increasing the liability. So if I don't do this, then what? Liabilities will be understated. Understated. Okay? In other words, I won't reflect that I owe as much as I actually do owe on my balance sheet. Okay, so there's 4, there's one more. This is the toughest to grasp onto conceptually. It's not really the toughest entry in when you're actually have to perform it, but depreciation. What is depreciation? Do what?
Loss of value.
All right, and what? You're right. Loss of value for what?
Your assets.
Assets. Okay? The inherent nature of an asset is to lose value. Okay? If you don't believe me, go buy a new car today. Pay $25,000 for it. Drive it around the block and try to sell it back to the dealership for the same price that you bought it. What's going to happen? Not a chance. Okay? They may say, I'm going to give you $22,000 or something like that if you're lucky. Okay? Why won't they give you that price? Because they know what? They know what assets do. They depreciate over time. Okay? Now, doesn't mean it's a bad car. Doesn't mean it doesn't work. All you did was take it a mile around the block. Okay? But because it's been driven, because it's been cranked up, somebody sat in the seat, pushed the gas, turned the radio on, flipped the air on, it loses value. Probably your first computer is not the one you're using today. Why? Computers lose value. Okay? The life of a computer is decreasing more and more and more. Alright? When we bought our first computer, it lasted about 8 years. Now, computer lasts about 3 or 4 years, and you got to replace it with all the new software and all this wonderful stuff. Phones, perfect example. Okay? It is the nature of assets to depreciate. Here's the exception. Okay? One asset, does not depreciate. Land. Okay? Land does not depreciate, all the other ones do. Land does not depreciate, all the other ones do. Alright, so, here we go. When we purchase an asset, okay, and we're setting the table here for the depreciation entry. When I purchase an asset, and you have done this entry, and let's keep it simple, all right? Purchased equipment for cash, $10,000. Here's your entry. You're going to say, oh, I'm going to debit equipment for $10,000. I don't know what that was. $10,000. And I'm going to credit cash because I spent cash for $10,000, and there's your entry. Okay? So this flows through and eventually hits the balance sheet. I'll have equipment on my balance sheet valued at $10,000. Cash will be reduced by $10,000. Okay? Now, the problem with this is that on this balance sheet down here, under assets, I've got equipment for $10,000. And we know what about that equipment? It depreciates. Okay? In other words, at the end of the year, let's say I buy this on January 1st. Okay? At the end of the year, this equipment is not worth $10,000. It's worth less, depending on what type of equipment it is. Alright? So, I have to have an accounting mechanism, that's the word I use, okay? I have to have an accounting mechanism to recognize the inherent decrease in the value of an asset. That's what this entry is. Okay? And this one is unique. Alright, here's what the entry looks like. I'm going to debit an expense, specifically depreciation expense. Okay? Specifically depreciation expense. And I'm going to credit a contra asset. Okay? Now we haven't used that adjective yet. Contra. Here's what a contra asset is. You know? Who knows? Assets have a normal what? Debit balance. Okay? A contra asset is what? It's an asset with a normal credit balance. Okay? So, sorry to burst your bubble. There's an exception to the rule. Okay? And it's called a contra asset. Now, here, this one has very specific accounts tied to it. You're going to debit depreciation expense, and the contra asset you're going to use, you haven't heard of this account yet. Here it is. Accumulated depreciation. Eventually, at some point out there, we don't know when, but at some point this equipment's going to be worthless. Right? Okay? Everything at some point doesn't have value anymore. We can't use it. Okay? Whether we just use it so much that it finally ran down, there's plenty of reasons. If the technology's obsolete, whatever. Eventually the asset is going to have no value. Right? So what I'm going to do is I'm going to make this adjusting entry. And what I'm going to do when I make this entry for the first time, let's make it on 12/31 of this year. Here's what I do. I debit depreciation expense and I credit accumulated depreciation. And let's make it for $1,000. Which means what? This hits the income statement, so I get charged as an expense for the loss of value in my assets. This hits what? It's a contra what? Asset, so it hits what? All assets hit the balance sheet, right? So this is going to hit the balance sheet, and it's going to be lined up right there. Accumulated depreciation, it's a contra asset, so it has a credit balance. That's how we're going to show that eventually, okay? So I can look at the balance sheet, and I know what? I paid $10,000 for this piece of equipment, and it's worth what? 10,000 minus 1,000 is 9,000. Okay? Now, next year I'm going to do what? On 12/31, I'm going to depreciate this equipment again for $1,000. This will then change to 2,000, and I show what on the balance sheet? I got a $10,000 piece of equipment. It's now depreciated 2,000, so it's worth 8. Right? Okay? I'll do it again in the third year, again in the fourth, fifth, sixth, until what? I'll do this 10 times. Until what? It has no value on my balance sheet. Alright? We'll get Accounting 202, you'll talk a lot about this. We're just kind of worried about the entry right now and what it looks like. But that's it. Now, companies love depreciation. Okay? Depreciation is a fabulous thing as far as the accounting world goes. Okay? Why? This is a big one. All right? This is one of those things that if you walk out of here with, top 5, this is one of the top 5. You can go to a company and they'll like you if you know this. Okay? Why is that a big deal?
Tax write-off?
Yes. What do you mean? Why? All expenses are tax write-offs. Okay? What's so fantastic about this one? You're exactly right.
Because you still get to keep your asset.
You get to keep your asset, and you don't spend what? Cash. Right? Most expenses look like this. Debit, rent expense, credit, cash. Here we credit what? Accumulated depreciation. Okay? So let's make sure we have this straight. I get to record an expense on my income statement, which reduces income. Reducing income reduces my tax bill, and I don't have to what? And I don't have to spend any cash? You got it. Okay? So, depreciation is a huge, huge deal. When Katrina came through, I don't know how old you all were when Katrina came through, but one of the things that the government passed was accelerated depreciation laws. Okay? What the government was trying to do was to encourage people to rebuild structures, rebuild buildings. If you go to downtown Jackson, the building called the Pinnacle Building that's down there on the corner of Capitol and Lamar, if you ever go down there, that building was built because of that legislation. It's called the GO Zone. You may have heard about the GO Zone. Okay? The company I work for built it. And I'm telling you, the only reason we did it is because of GO Zone. What do we get to do? We get to build this asset all right, and depreciate it very rapidly. Okay? Why is that good for us? Less income, less taxes, okay? Because I get that heavy depreciation expense. Okay? So this is a real advantage, and especially in the accounting world, if you're going that route, even if you're not, this will impact you in some way. That's useful information there. All right, if I don't do this, the expenses will be overstated. If expenses are overstated, no, I got that wrong. If I don't do this, if I don't debit this expense, expenses will be understated. I was thinking income. Income will be what? There you go. And here's the tricky one. This flows through to what? This flows through to the asset section. Yes, it's a contra asset, but it still flows through to the asset section. If I don't do this, what are my assets going to be? Overstated. Okay? And think about it this way. If I have this $10,000 piece of equipment down here, again, here's my balance sheet that I erased. All right? I've got a $10,000 piece of equipment. If I don't do this and recognize the accumulated depreciation that goes along with it, then what? This will always stay zero. Zero. Okay? Fascinating little piece of history. When I was growing up, in I'm trying to think. The first movie that I ever saw in the theater was Rocky IV. Y'all familiar with Rocky IV? Okay? It's US versus the Russian. The Soviets were a huge deal when I was growing up. My brother, who was 10 years older than me, made me afraid of them. Because at that point, you've pretty much grown up in there's one power in the world and it's us. That wasn't the case when I was a youngster. And our mother just put the fear of the Soviets in me. He was like, there might be one in the closet, I don't know. Be careful. That kind of stuff. But there was a big question as to whether socialism, communism, was going to be the predominant world order, or was it going to be capitalism, what we stood for. And the reason it unraveled so quickly, they didn't depreciate their assets. So they had tanks that were 25 years old that they what? They said, here's the value of it, it's what we paid for it in 1960. Okay? They never depreciated their assets. So we always thought they were a lot wealthier than they really were. Okay? Because their balance sheet, their assets were overstated. Okay? Why? Because they didn't depreciate them. So, interesting little fact. I'm not saying that's why it unraveled, but it's, it played into the deception that we thought they were much wealthier than they actually were. Okay. Those are the 5. Those are the entries. Those are the general form. This is the result. I do have your grade sheets for you.